What is going on, guys, and welcome back to the Young and Intelligent Money Investing channel. Today we're going to be talking about the best ETF, I think, in a ETF I'm going to be starting a position on to buy in a rising rates environment, interest rates, and the Federal Reserve raising interest rates. But before we get into that, I want to just welcome all the new subscribers we have to the channel. The growth's been awesome to see over the last few days, and I really appreciate all you guys for being here. Now let's get in the video. So this ETF, as you can see, is going to be VYM. Essentially, this is a Vanguard High Dividend Yield ETF, but what's special about this one is that it completely excludes REITs from it. So to read the description, the Vanguard High Dividend Yield ETF tracks the FTSE High Dividend Yield Index, the index that selects high dividend paying U.S. companies, excluding REITs, and weights them by market cap. So essentially, you're going to be getting high dividend yield. So as you can see, it's 3%, about a whole percent over what the S&P 500 does. It's a little bit less than SPHD, but that's because it does exclude the REITs. And if you guys remember, REITs are real estate investment trusts that, by law, for tax purposes, have to pay out 90% of their profits in dividends. So for that reason, they have uncharacteristically high yields. And the reason you want to stay away from them in a high rate environment, which unfortunately I'm not doing, as you guys know, I have a very high real estate exposure in my portfolio, which is why I want to add VYM. So when rates are rising, that means it's more expensive to borrow money from the bank. So if they raise rates by 1/4%, that means you're going to have to pay an extra 1/4% on the interest on the amount of money you borrow. And REITs are extremely debt heavy because they need to borrow a lot of money to be able to purchase big real estate deals. So when rates are rising, their profits sink. And if you guys hold SPHD or any other real estate stock, you probably realize or have noticed that there's days where real estate as a whole is down in a big way, and that's usually because the Federal Reserve is talking about raising rates. And that's exactly what's happening right now. I was reading a Wall Street Journal article the other day, and it said that we're expecting a rate hike this month, in December of 2017, and then 4 rate hikes quarterly in 2018. So for that reason, VYM is going to be a fantastic play if you're looking for a dividend ETF that is going to keep you away from big exposure to real estate. And it's a great way to diversify a dividend portfolio because I know a lot of dividend portfolios have high exposure to real estate. So let's look at its performance so far. For the last week, it's down. I'm sure on talks of raising rates, likely. No, not sorry, I'm totally off on that. Market's just put down as a whole, not on talks of raising rates. That'd be a different ETF. For the past month, 3.2%. That's great. 3 months, 8%. That's a fantastic return. 1 year, 15.8%. And over the last 5 years, 99.22%. And that is all while paying a 3% dividend yield, which honestly doesn't get much better than that. And another perk of this ETF is that it is put on by Vanguard. And if you guys know about Vanguard, they're famous for having extremely low expense ratios. Essentially, what an expense ratio is what the company that produces the ETF takes out of the fund every year. So let's say it has a 0.3% expense ratio. That means at certain increments, they're going to take that entire, they're going to take 0.3% out of the fund, and they're going to keep that as their own profit for the year. Or I know a lot of other ETFs. SPHD is 0.3%, OUSA is 1%, VOO, which is another Vanguard ETF, is 0.04%, which is incredibly low and fantastic. So definitely look out for that expense ratio when you're shopping around for ETFs. So I hope you guys enjoyed this video. VYM is going to be my next addition to my portfolio. And you guys know I like to stay ETF heavy because it really keeps you safe, and that's exactly what I want to push on this channel and what I want to have going forward. No really high risky stocks picks or anything like that. Alright, so please leave a like and a comment if you guys enjoyed it. Welcome once again, welcome to the new subscribers, and I'll see you guys next time.